everybody. Welcome back to another episode of Building Your Wealth Bridge. I know we normally have a couple of team members on our podcast, but I am doing this episode solo for the second time. I did one about a year ago based on Social Security, and this episode will have some echoes of that episode in that, number one, this episode is built off of some client case studies that have popped up. Certain topic some younger clients have been asking me about the past year, as well as my own personal experience dealing with this topic. And the topic in question really has to do with people that have filed for a mortgage for the first time and are trying to get some good planning done around questions like how much I should be putting down in terms of a down payment for my mortgage. And really, the main thing I've been discussing, with my clients and then thinking about for myself is this idea of additional payments. Should I be making any additional payments on my mortgage and look to pay off my mortgage sooner than the term of the loan actually is? The second echo, where this is similar to the Social Security podcast, is that this is more of an art than a science. To be candid, I'm not a mortgage expert. I'm a financial advisor that has experience in buying my first home last year. But just to give kind of my opinions on how I think people might want to approach this topic and some of the pros and cons to thinking about paying off your mortgage early or waiting until the full term of the loan to finally pay it off. So what I put together was basically a collection of different spreadsheets, and this spreadsheet was actually provided to me by a gentleman by the name of Mike Del Preto, who was really our mortgage specialist that helped guide us through the process of filing for our first mortgage. And I remember he shared this spreadsheet with me when I was asking him questions about how much I should be putting down on my house. Should I be doing more? Should I be doing less? What about this idea of additional payments? How does that work? So it's been a very helpful resource for myself and for my clients. I basically put together just a hypothetical, based off of a couple of client experiences and, came up with some numbers similar to theirs. So no, these numbers are not based off of any actual case and certainly not my own. But one thing I thought I'd start with, I've mentioned, approaching this, I think, is a little bit more of an art than a science. And when I talked about Social Security, what I meant by that was I told people the biggest question mark was, you just don't know how long you're going to live. And that's really a key component of figuring out when you're going to file for Social Security, whether it's earlier or later. And it's a massive question mark. As it pertains to this topic of paying off your mortgage early, I think the biggest question mark is what's the market going to do? And, if anybody is telling you they have a good sense of exactly what it's going to do year over year for the next 20 years, I think they've got a bridge to sell you as well. So, I think the biggest question that comes up and the biggest debate around this topic starts with, what is the interest rate that you are paying on your mortgage? Okay. And that's changed significantly over the last couple of years. I know of some clients that were able to refinance their mortgage prior to 2022 at what seemed like rock bottom rates of like 2.5%, 2.75%. And now people are dealing with, just a year or two ago, filing for new mortgages north of 6%. Those have come down somewhat. But there's this big debate around at what point does it make more sense to either pay off your mortgage early or to take that money that could pay off the mortgage and simply invest it in the stock market. Okay. And you've got people at both ends of the spectrum. I think, Dave Ramsey's team is a good example of people that say, if you've got all these goals of having an emergency fund, having, a savings account for bigger expenses over a year or two, you're funding your retirement accounts, their advice is pay that home off as soon as possible. And you've got people at the other end of the spectrum saying that is just absolutely ridiculous. The best thing you can do is invest your money for the long term. And they really feel strongly that, by taking an aggressive approach, the return you can get on your money in the stock market is going to be far above and beyond, the interest you're paying on your mortgage. So, just kind of to level set that and give you a sense of some things to think about. Number one, where we're at today is very different than where we were a couple of years ago. Paying a 5.5% mortgage rate is a lot more difficult to overcome than a 2.5% mortgage rate. I think another really important thing to think about when I talk to people about this issue is this idea of, okay, if it's a younger person, they say, well, if I invest that money, in 100% stocks over the long term, very confident that I can beat 5.5%. One thing I'll bring up to them is the idea of, well, where is that money going? Is it going into a retirement account where it's tax deferred, or are you taking that money and putting it into a taxable account? Because one thing to take into account is taxes, right? So particularly for people that are putting money into a taxable account, typically people will have to pay capital gains tax on money that they are putting into there, seeing gains on with the investments, and then ultimately selling it. So if you can plan on, for most people, paying 15% capital gains tax, you want to factor that in when you're comparing the rate of return you're going to get versus the mortgage interest rate that you're paying, right? So what looks like on the face of it, the example we use here is around, 5.5% interest rate. you know, uh, what's going to be your after-tax rate of return that you'll need to get to beat that? Or I should say, your pre-tax rate of return might have to be 6.5, right, in order to get an after-tax rate of return close to 5.5%. So I think that's really important, is taking into account the taxes when you're thinking about the actual gross percentage you're getting on your investments versus what you actually keep at the end of the day. Another thing that was really eye-opening to me when I went to file my first mortgage was thinking, and I think this speaks to people that say, hey, maybe it does make sense to take some money and invest it versus paying down your mortgage, is this idea of how interest is actually paid on a mortgage loan. I think on the face of it, not being very knowledgeable in this area, I thought, hey, on a 20-year loan, if I'm paying 5.5%, and my, average payment, if we look down here, is it 27.50 a month, that the interest portion of that would be the exact same every month for 20 years. And that's just not the case. Much earlier on in the maturity of a loan, you're paying a lot more in interest. So like in that first month that you're making a payment of that 27.50, like over 1,800 is interest. As you get much later on in the loan, you can see that these interest payments go down and down and down. And so I think that's relevant, okay, when you think about interest that you're paying on a mortgage versus investing it and seeing compounded growth, is that over the long term, 10, 15 years from now, the actual interest that you're paying on the outstanding loan becomes less and less and less. Okay. Versus if you're investing that money, the compounded growth is a little bit more exponential if you continue to see good returns. So it's not just a simple equation of, if my mortgage rate is 5.5% a year, that's the after-tax rate of return I have to make in order to beat that, because this, game that gets played of the more the interest gets collected by the bank up front is relevant in, considering your strategy around it. Okay. And I think that was also one interesting thing to me when I was thinking about just mortgages in general, and just the idea that, hey, they can help fund the purchase of this home that I am getting. And I have a long time to pay that back. Seems like a good deal for me. But this is where the banks win, is that they collect a significant amount of the interest on that loan up front. So one thing I loved about this spreadsheet, that was sent over to me by my mortgage broker, is after, I think it's 5 years, you see in this scenario, it was around $101,000 of interest paid on a total interest of 260 over the life of the loan. So I think that's 2/5. That's like 40% of the interest, given this type of scenario where it's like, hey, if my loan amounts $400,000, 5.5% interest rate over 20 years, the bank gets 40% of the interest, if I'm doing my math right on that, based on these figures, over the first 25% of the loan. So they really get ahead of this issue by collecting their interest up front. So by the time that you get to the end of the loan, even if you decide to pay it off early later on, they've already collected a bulk of the interest that they were going to collect anyways. And so that is, I think, is how, the bank, quote unquote, wins. So some of the questions that I've gotten from clients over the last year or so, and I think this topic is particularly relevant to people that maybe filed for a mortgage, in the last 5 years. And they're just doing a lot better financially than they predicted that they would. And they're just saying, I've got a lot of, loose cash laying around, and they're asking themselves, should I invest this or should I pay down my mortgage? And, what's going to be the difference, based on which path I choose. So some of the things I wanted to run through that were eye-opening to me was just starting with, this idea of a down payment. Okay. So the example that I'm going to use here is essentially for all of these cases outside of the screen I'm currently on, will be a $500,000 mortgage loan, 5.5% interest over 20 years, basically starting in May of 26. Okay. But I know something that will come up for people that are a little bit cash heavy may say, hey, I have the ability to maybe put more down. Like, what if I have an extra 100,000 that I could put down on the loan? One thing that I found interesting in running these numbers was, let's say you have 100,000 extra dollars, you put it down on your home, over the lifetime of that loan. If you don't make any additional payments, you just say, hey, I'm gonna take that extra 100,000 and put it down as a down payment, but then I'm just gonna make my payments over 20 years. The total interest over that period was around $260,000. What was very eye-opening to me was just taking a look at, okay, let's say you don't make that additional, down payment as part of the loan that you open. And so you start off with $500,000, okay, in a loan, same exact scenario, 5.5% interest over 20 years. But let's say after 10 years into the loan, you say, you know what, now I've got $100,000 extra, and I'm going to put that money down towards the loan to pay some of that off early. So basically what we're comparing is you put $100,000 down extra upfront, okay, as part of the down payment, or you wait 10 years and then you put it down in the form of an additional payment. The lifetime interest is very, very close. It's around $266,000. And I think the reason for that is because any additional payment that you make comes directly off of principal, which is a huge difference maker. So basically the differences between these two scenarios is, by making a bigger down payment up front, okay, your monthly payment you can see is like $27.50, I think, a month for 20 years, but you don't make any additional payments. So you're making payments for 20 full years, and you're paying the full interest over those 20 full years. Versus, if you put less down, your monthly payment is higher, which is a potential downside of that. It's like $34.50 a month essentially. But when you put 100,000 down after 10 years, it comes directly off of the principal. So it basically means that you're paying off that loan sooner, which was just really surprising to me, that the total interest ended up being very similar because you pay off the loan so much sooner after paying 100,000 after 10 years. So I think that was very eye-opening to me. One thing that I looked at in speaking with some clients, and kind of getting back to level setting, was just this idea of, if you do additional payments, like there's a variety of different ways you could approach it. And so the question becomes, like, what way should you approach it? If you're somebody that says, I know how the bank wins because they collect most of their interest up front. How do I beat the bank? So if this scenario kind of level sets everything, let's say it was a $500,000 loan, you got 5.5% interest on that loan over 20 years and starts in May, essentially without making any additional payments. Okay, the total interest over the life of that loan might be $325,000 over a 20-year period. Okay, so let's say somebody said, listen, I do want to make some additional payments, but like, is that really going to make a difference over the long term? And so I've recently talked with a client where we basically took a number and we said, okay, what if we had $100,000 to make in additional payments? How can we structure this? What would the difference be between, let's say we took 100,000 and made an additional payment now? What would it look like if we did it, 10 years into the loan? What would it look like if we just did a small monthly amount every single month for the course of, 7 years? And what if we did kind of a mix and match where we did like a decent chunk up front and then we did smaller chunks like every 6 months? So, kind of using this baseline, $500,000 loan, 5.5% interest, 20-year loan, the total interest was around $325,000. One thing that I thought was interesting, looking at, and we kind of ran through this already, was just, okay, what if we waited 10 years, and really your career takes off and then you have a lot of cash on hand down the line? How much of a cost saving is that really? And it's not insignificant, right? You go from like 325,000 total interest to around 266 all in by just making one big lump sum additional payment, 10 years into the loan. Okay. What I thought was, a good follow up to that was like, okay, well, what if we did that in smaller pieces, over like the first 7 years of the loan? So what if, we did $1,200 in additional payments every single month for the first 7 years, which would basically be like 100 grand after 7 years. That was really eye-opening to me. Again, using all the same variables, but just changing the fact that instead of waiting 10 years and doing a big lump sum, by just doing 1,200 a month, the total interest, we started at 325, then we got to 266 by doing that lump sum after 10 years. Now doing just a small monthly thing, you drop all the way to 209. So you went from 325 to 209 just by making a small monthly payment every single month. Once we had discussed that, and I think these next two scenarios are, particularly relevant to like I said, people that just are cash heavy right now. Maybe they put down a smaller down payment, and maybe they thought they had another big purchase coming up or some expenses that didn't come through, and now they've got extra cash, and they think, what's the best way to maybe put some of this towards our mortgage and pay it off early? Was this idea of what if we took, of that 100,000 that we have, what if we put 50 towards it up front, and then we paid, $10,000 every 6 months for the next 2.5 years? And so that one came out to around, $182,000. So again, we started at 325, and then with scenario two, we were 266, and then with $1,200 a month, we're 209. By putting 50,000 up front and then 10,000 every 6 months, now you're at 182. So I think you can see the trend here, which is essentially that if you want to beat the bank, making additional payments as early on in the loan period as you can is going to be more beneficial to you. And that's kind of the last scenario here, which, may seem like it's not applicable to a lot of people, but it could be for high earners or people that are cash heavy. Just this idea of, hey, even going back to this idea of, hey, if I took, put 100,000 towards the down payment, would pay to over 20 years, versus if I started out with a $500,000 loan versus 400,000, and then immediately made $100,000 additional payment, you can see that the total interest goes down to 173. So I guess at the end of the day, what I'm getting at least for me, was that this was extremely eye-opening about how the numbers change as you strategize around this. And frankly, when I was talking to my client about these different options, we found that there's probably a middle ground, right? If you think about the prospect of putting 100 grand down like immediately into the maturity of a loan, it drops you down to, the most, the 173. But if you compare that to, these other two scenarios where, hey, putting $1,200 a month for 7 years, 173 versus 209, it's $36,000. It's not nothing, but it's, not strikingly different when you think about how you're able to space out those payments over 7 years versus putting a huge chunk up front. And also, I think for the client I talked to, like the main sweet spot was like, well, what if we put like 30 or 50,000 up front, and then we kind of take smaller chunks, whether it's like $8,000 or $10,000 every 6 months until we get to that $100,000 level. That might strike a really good balance between, making sure that you are minimizing the total amount of interest that you are paying on your mortgage. At the same time, you're giving yourself some breathing room as it relates to your cash flow, right? And so that was really it in a nutshell. So, like I said, this is more of an art than a science. I know there's some people out there that would say, hey, some of the biggest negatives that I didn't cover would be that, hey, once this money gets put towards your mortgage, it's tied up in your house, right? So basically you are banking on the appreciation of the home that you have. If you look at it from an investment standpoint, that's basically, the growth that you're going to see is just based on how the value of your home grows. Some people will also say, what, tying up money in your home, it becomes a lot less liquid than your investments, right? So that's something else that I think you need to consider. Is having money tied up in your home, makes it a little less accessible. There are strategies like opening up a HELOC and being able to, access some cash flow, tap into the equity in your home. But I think the one thing I would stand firm on is this idea that if you are going to make additional payments, make them as early on in the loan as you can. Because just going back to what we talked about with, whatever your monthly amount is going to be, if you look at what the interest portion is early on in the loan versus what is later in the loan, it can really, save you some hard dollars, I think. If you're somebody that says, well, I could afford to do, 100,000 over a couple of years, but why don't we just do 1,200 a month for 7 years? I just like that consistent pace. If you know you're going to have that cash regardless, it's good to know how much more that costs you in hard dollars when you think about the interest, over that few year period, just for, the sake of doing something consistently and in smaller chunks. So I hope this has been helpful to people. I would love to hear from others in terms of what their strategies are surrounding mortgages, what items I may have missed. But I think this is kind of a fascinating topic, and it's one that a lot of people deal with. So for clients of ours, if you have any questions or like to use the spreadsheet as a resource, please reach out to our firm.